I am recording this on Saturday night. By the time you see this video, it might already be too late. The markets might have already gapped. Something just happened in the last 6 hours that is going to change everything when the futures market opens Sunday evening. And if you own silver, if you own gold, if you have any exposure to precious metals whatsoever, you need to stop everything you are doing right now and pay attention to what I am about to show you. Oil depots in the capital city are burning. Not military bases, not missile installations, not radar facilities, oil depots, energy infrastructure. For the first time in this entire conflict, they targeted the oil supply directly, flames and smoke rising over the city from 2 separate oil facilities, confirmed by official news agencies, confirmed by journalists on the ground. This is not speculation, this is happening right now. And while the world sleeps, while traders are away from their screens, while most people have no idea what just occurred, the math on everything just changed. Before I go any further, I need to ask you something. What time is it where you are right now? What country are you watching from? Drop it in the comments. I want to know. Because depending on when you see this video, the market might have already moved. And I want to track in real time who saw this before the open and who saw it after. If you're watching this before Sunday evening futures open, you are ahead of 99% of traders who have no idea what is coming. If you're watching this after the Monday open, check the silver price right now and tell me in the comments if what I am about to predict actually happened. This is Finance Currency. Hit the subscribe button right now if you are new here. I cover the data that mainstream finance ignores. I show you the numbers that the big institutions do not want you to see. And tonight, I am going to connect 3 separate crises that are all pointing to the same conclusion. Let me give you the 3 headlines first. Then I am going to break down each one in detail. And at the end of this video, I am going to show you why all 3 are connected and what that means for Monday morning. Headline number 1. COMEX registered silver just dropped to 81 million ounces. There are 294 million ounces of paper claims against it. That is a ratio of 3.6 to 1. For every single ounce of real deliverable silver sitting in the vaults, there are 3.6 ounces of paper claims against it. Headline number 2. The Shanghai Futures Exchange just suspended over 40 groups of trader accounts. They have 8 million ounces of silver left in their vaults. 8 million. And they are actively preventing traders from opening new positions because they know if they let everyone trade freely, those 8 million ounces would be gone in hours. Headline number 3. Oil depots were bombed overnight. Energy infrastructure hit for the first time. Crude oil closed the week at $90 after pumping 16% in a single trading session. 16% in one day. That is not a normal move. That is a panic move. That is the market screaming that something fundamental has changed. 3 separate stories, 3 separate data points, all happening in the same week, all pointing to the same conclusion. Silver closed at $84.47. Just 53 cents below the $85 resistance level I've been talking about for weeks. That level has capped every rally. That level has rejected every breakout attempt. That level is the ceiling that the big players have defended again and again. But here's what makes this week different from every other week. The pressure underneath that ceiling has never been this extreme. The physical supply has never been this tight. The paper claims have never been this stretched. And the macro environment has never been this explosive. $85 is not just a number on a chart. It is the line in the sand. If silver breaks above $85 and holds, everything changes. The short positions get squeezed. The momentum traders pile in. The narrative shifts from silver is capped to silver is breaking out. And if silver rejects at $85 again, it tells you the manipulation is still in control. It tells you the paper game is still working. It tells you the big players successfully sold into the panic buying one more time. That binary outcome is what makes this the most important week for silver in months, maybe years. But I am getting ahead of myself. Let me start with the COMEX data because this is the foundation for understanding everything else. This is the math that nobody in mainstream media is showing you. And once you see it, you cannot unsee it. Stay with me through this entire video. I know it is long, I know there is a lot of data, but I promise you, by the end, you will understand exactly what is happening in the silver market, why it is happening now, and what it means for your money. The comment section is going to be the most important part of this video. I want your analysis, I want your predictions, I want to know what time you are watching and where you are watching from, and I will pin the best comments at the top. Let us begin. COMEX registered silver just dropped to 81.2 million ounces. Let me put that number in context because numbers without context are meaningless. At the beginning of February, COMEX registered silver was over 102 million ounces. In just 5 weeks, over 20 million ounces have left the registered category. That is a 20% decline in deliverable silver in just over a month. The metal that is actually available for delivery when someone says, "I want my silver," is disappearing at a rate that I have never seen in my entire time covering this market. But here is where it gets scary. Pull up the open interest data. March 2026. COMEX silver open interest is sitting at over 58,000 contracts. Each contract represents 5,000 ounces of silver. Do the math with me. 58,000 contracts multiplied by 5,000 ounces equals 290 million ounces of silver that exists on paper. Round it up with other expiration months and you get approximately 294 million ounces of paper claims. 294 million ounces of paper. 81 million ounces of real metal. That is a ratio of 3.6 to 1. For every single ounce of actual deliverable silver sitting in the COMEX vaults, there are 3.6 ounces of paper promises floating around in the market. Now I want you to think about what that really means, because most people hear these numbers and their eyes glaze over. Let me make it concrete. Imagine a bank that has $81 in cash in its vault. Now imagine that same bank has issued $294 in withdrawal slips that people can cash at any time. As long as everyone believes the bank is solid, as long as no one actually tries to withdraw, the system works. The bank functions. The withdrawal slips trade hands. Everyone pretends the cash is there. But what happens when enough people show up at the window at the same time and say, "I want my money"? The bank cannot deliver. The math does not work. And when the math does not work, either someone does not get their cash, or the bank has to redefine what cash means. That is exactly what is happening in the silver market right now. 294 million ounces of claims against 81 million ounces of reality. The only thing keeping the system functioning is the assumption that most paper holders will never ask for delivery. They will settle in cash. They will roll their contracts forward. They will play the paper game forever. But what happens when that assumption breaks? Let me put this ratio in historical context because I want you to understand how abnormal this situation is. During previous tight periods in the silver market, when the ratio of paper claims to registered metal would reach 2 to 1, traders would start getting nervous. 2 to 1 was considered the danger zone. 2 to 1 was when people started asking uncomfortable questions about whether the COMEX could actually deliver. We are at 3.6 to 1. That is nearly double what the market historically considered dangerous. And it is getting worse every single week because registered silver keeps dropping while open interest is not declining at the same rate. The gap is not narrowing. The gap is widening. And here is what makes me lose sleep at night about this. COMEX is a delivery market. That is its entire purpose. That is its reason for existing. People buy contracts, and at expiration they can choose to take delivery of physical metal. The credibility of the entire exchange depends on its ability to deliver when asked. If the ratio gets extreme enough, if enough participants lose confidence that delivery can actually happen, the entire structure of the COMEX silver market comes into question. Not the price, the structure, the trust, and once trust in a market breaks, it does not come back easily. Ask anyone who was trading in 2008. Ask anyone who remembers what happened when confidence evaporated overnight. This week alone, COMEX lost 3.2 million ounces of silver in a single day. Not a single week, a single day. 3.2 million ounces walked out the door in 24 hours. That is not a gradual drain. That is a hemorrhage. That is someone bleeding out on the table while the doctors pretend everything is fine. Now, some people will say, but wait, what about eligible inventory? There is more silver in the vaults than just the registered category. And they are right. Eligible inventory, which is the silver that could potentially be moved to registered, is around 279 million ounces. Total COMEX silver stocks are around 371 million ounces. But here is what most people do not understand about eligible silver. Much of that eligible silver is tied up. Banks hold it. ETFs hold it. It is being used as collateral for other financial instruments. Just because silver is sitting in a vault does not mean it can be moved to the delivery pile. Just because it exists does not mean it is available. The actual freely available silver that could cover these contracts is a fraction of what the headline number suggests. And compare those total stocks of 371 million ounces to the paper demand of 294 million ounces. We are approaching a point where the paper claims on silver are getting dangerously close to the total amount of silver in the entire COMEX system. Not just registered, total. That has never happened before. And the rate of decline is accelerating. In my years covering this market, I have seen tight conditions. I have seen low inventories. I have seen nervous traders. But I have never seen a situation where the ratio of paper claims to deliverable metal is this extreme while the vaults are draining this fast at the same time. Both things happening simultaneously is what makes this different from anything in recent history. This is not a normal market. This is a market running on borrowed time. And while COMEX drains, let me tell you what is happening on the other side of the world, because this is the part that nobody in Western media is covering. And I think it might be the most important development of the entire week. The Shanghai Futures Exchange just cracked down hard on its own traders. And when I say cracked down, I mean they went nuclear. They issued an official announcement citing Article 16 of their abnormal trading management rules. What happened is that multiple groups of accounts exceeded their daily position opening limits. In plain language, traders were taking on too many new silver positions too fast. They were buying too aggressively. And the exchange said no. They suspended the ability of these accounts to open new positions. Here are the numbers. In January alone, the Shanghai Futures Exchange suspended 40 groups of accounts. In February, they suspended another 25 plus groups. In the first week of March, already 9 more groups suspended. And with the volatility we just saw, there could be more suspensions coming Monday. The exchange is not playing around. The government is sending a very clear message. They do not want speculative frenzy in silver. They do not want coordinated buying. They do not want the kind of uncontrolled demand that could drain what little silver they have left. And let me remind you how little that is. The Shanghai Futures Exchange has 8 million ounces of silver in its vaults. 8 million. When I first reported this number a few videos ago, it was alarming. Now, with the exchange actively suspending traders to prevent a run on that remaining inventory, it is beyond alarming. It is crisis management. It is desperation. The exchange is essentially rationing access to silver positions because they know that if they let everyone trade freely, those remaining 8 million ounces would be gone in days, maybe hours. They are protecting the last drops of physical silver in their system by limiting who can buy. Think about that. Really think about it. The second largest economy in the world, the largest manufacturing base on the planet, the biggest consumer of industrial silver for solar panels, electronics, EVs, military applications. That country's main commodity exchange has 8 million ounces of silver left and is actively suspending traders who try to buy. If that does not tell you something about the true state of global silver availability, I do not know what will. Now think about what this tells you about the direction of physical metal flows globally. Silver has been flowing from the west to the east for months. From COMEX vaults in New York, from LBMA vaults in London, to Shanghai, to India. The premiums in Asia have been massive. Buyers in China and India have been willing to pay significantly above the COMEX price just to get their hands on physical metal. That premium is what pulls metal eastward. When buyers in Shanghai are paying more than buyers in New York, the metal moves east, simple economics. And now the exchange on the receiving end of all those flows, the exchange that has been sucking silver out of Western vaults for months, is saying we have 8 million ounces left and we are suspending traders who try to buy too aggressively. If the destination is running out after receiving all those flows, what does that tell you about global silver availability? It tells you demand is overwhelming supply at a fundamental level. It tells you the industrial consumption is not slowing down. It tells you the strategic hoarding is intensifying. It tells you the paper price of $84 does not reflect the physical reality on the ground. China is the world's largest consumer of industrial silver. Solar panels require silver, every single solar panel. And China is installing more solar capacity than the rest of the world combined. Electric vehicles require silver. Every EV has more silver in it than a traditional car, and China is producing more EVs than any other country. Electronics require silver. Military applications require silver. Medical devices require silver. Their demand is not optional. It is structural. They need silver, and their exchange is running out of it. And they are suspending their own traders to slow the drain. That is not a market that is functioning normally. That is a market in crisis management mode. And here's the contrast that absolutely blows my mind. COMEX in the United States is also draining, 3.2 million ounces gone in a single day, the ratio at 3.6 to 1 and widening, the registered category dropping 20% in 5 weeks. But has COMEX taken any similar action? No position limits being enforced aggressively? No suspensions? No crackdown on speculative plays? COMEX is letting the market operate as if everything is normal while the vaults drain at the fastest pace in years. Two exchanges, both running low on silver. One is panicking and cracking down. The other is acting like nothing is wrong. The question you should be asking yourself is this: which exchange has the right response? And what happens to the one that is not paying attention? I think China knows something. I think they see the supply data. I think they understand that the current consumption rate cannot be sustained at these prices, and I think they are positioning accordingly by restricting speculative demand and protecting their remaining physical inventory. Meanwhile, COMEX keeps draining. The paper game keeps playing, and the ratio keeps widening. Something has to give. The math demands it. But before I connect these dots, let me walk you through what happened with the oil strike this weekend, because this is the catalyst that changes the timeline on everything. If you are still watching, drop a comment right now. Tell me still here. I want to know how many people are making it through this entire breakdown, because what I'm about to show you about the oil strike is the part that ties everything together. And make sure you are subscribed to Finance Currency. Hit that subscribe button right now, because the data I'm about to show you is not being covered anywhere else, not like this. On Saturday, military forces struck an oil depot in the southern part of the capital city. A second oil depot in the northwestern area was also hit. Journalists on the ground reported flames and smoke rising from the sites. This is confirmed. This is not rumor. This is not speculation. Official news agencies have reported it. Footage exists. The oil is burning, and this changes everything. Here's why. Up until this weekend, the strikes in this conflict were limited to military targets, missile installations, radar facilities, naval assets, military bases. The targets were military in nature. Oil was left alone. Energy infrastructure was off limits, and there was a reason for that. As long as oil infrastructure remained untouched, the market could tell itself a story. The story was, this is a military conflict. It will end when military objectives are achieved and oil production will continue throughout. That story kept a ceiling on oil prices. That story allowed traders to believe the supply disruption was temporary. That story is now burning along with the depots. If oil infrastructure is now a target, the risk premium on oil goes up dramatically. We are no longer talking about a military conflict with economic side effects. We are talking about energy warfare, direct, intentional, strategic targeting of energy supply. Roughly 3.4 million barrels per day of production is now at risk, not because production facilities were hit, but because storage and export infrastructure is being degraded. Even if the wells keep pumping, the oil has to go somewhere. It has to be stored. It has to be shipped. And when the storage facilities are burning, the entire supply chain gets disrupted. The Strait of Hormuz is already compromised. Reports indicate maritime traffic through the strait is down 70%. Ships are not moving. Multiple tankers have been damaged. Roughly 150 ships are stranded around the waterway. And now the oil that was being stored for eventual shipment is literally on fire. The supply disruption just went from temporary to potentially structural. Let me give you the numbers from Friday's trading session because they tell the story better than anything else. Crude oil closed the week near $90 a barrel. On the last trading day of the week, crude oil pumped 16%. In a single session, 16%. That is not a normal move in oil. Normal moves are 1%, 2%, maybe 3% on a volatile day. 16% in one session is the market suddenly waking up to the fact that something fundamental has shifted. 16% is panic. 16% is repricing of risk in real time. 16% is traders scrambling to cover shorts and establish long positions before the weekend news made things even worse. And then the weekend news made things worse, much worse. Oil at $90 with depots burning is a setup for triple digits. $100 oil is no longer a question of if, but when. And triple-digit oil changes the math on everything. Let me walk you through the chain reaction that gold and silver investors need to understand. Oil at $90 and climbing means higher input costs across the entire economy. Transportation costs go up, manufacturing costs go up, food production costs go up. Everything that moves, everything that gets made, everything that gets shipped costs more. Higher costs mean higher inflation. The inflation that everyone thought was coming down is about to reverse course. The disinflation narrative is about to die. Higher inflation means the central bank cannot cut interest rates. They were planning to cut. The market was pricing in multiple cuts this year. That expectation is now in jeopardy. If the central bank cannot cut rates, interest rates stay higher for longer. And higher rates typically strengthen the currency. A stronger currency creates headwinds for gold and silver in the short term. When the dollar rises, gold priced in dollars tends to face selling pressure. But here is the twist. Here is what most people miss. At some point, higher oil prices start breaking the economy. When gasoline hits $5 or $6 per gallon, consumers stop spending. Business costs skyrocket. Profit margins collapse. The economy weakens. And a weakening economy eventually forces the central bank to cut rates regardless of inflation. They have no choice. They have to save the economy even if it means letting inflation run hot. That scenario has a name. It is called stagflation, economic stagnation combined with inflation, the worst of both worlds. And stagflation is the single most bullish environment for gold and silver that exists. We saw it in the 1970s. Gold went from $35 to $850. Silver went from $2 to $50. Those are not typos. Those are the actual moves that happened when the economy stagnated and inflation ran hot simultaneously. The oil depot bombing does not just affect oil prices. It accelerates the timeline for stagflation. It brings forward the moment where the central bank has to choose between fighting inflation and saving the economy. And when that choice gets made, when the central bank is forced to sacrifice one goal for the other, gold and silver do not just go up, they explode. Not slowly, violently, because the market reprices decades of inflation expectations in a matter of weeks. The next rate decision is coming up on March 18th. 12 days from now, inflation data comes out on March 11th. If oil keeps surging because of the infrastructure attacks and inflation data comes in hot, the central bank is going to be standing in front of cameras telling the country that they cannot cut rates while everything is getting more expensive. Gas, food, utilities, insurance, rent, all of it going up. And the central bank saying, we cannot help. That is the moment where public confidence in the system starts cracking, and that crack is where gold and silver rush in. Now let me connect all three of these stories, because I promised you at the beginning that they all point to the same conclusion. Story 1. COMEX has 81 million ounces of registered silver against 294 million ounces of paper claims. The ratio is 3.6 to 1 and widening. The vaults lost 3.2 million ounces in a single day. The deliverable supply is hemorrhaging while the paper claims remain elevated. Story 2. China has 8 million ounces left on the Shanghai Futures Exchange. They are actively suspending traders to prevent a run on inventory. The government is in crisis management mode for silver. The world's largest industrial consumer is rationing access to positions because the physical supply is nearly gone. Story 3. Oil infrastructure was bombed overnight for the first time. Energy warfare has begun. Crude oil is at $90 after a 16% single-day move. Stagflation risk just spiked. The macro environment for precious metals just got rocket fuel poured on it. All three of these stories are telling you the same thing. Physical silver is disappearing from the system. The authorities in Asia are panicking about it. The paper market is stretched to a breaking point, and the macro catalyst that could trigger a repricing of everything just landed. This is not three separate crises. This is one crisis with three faces: the supply crisis, the confidence crisis, and the inflation crisis, all converging at the same moment, all hitting the market on the same Monday morning. Here is what I think happens next. And I want to be clear, this is my analysis based on the data I just showed you. This is not financial advice. This is my interpretation of the numbers. Monday morning, the gold and silver markets are going to gap. The oil depot news happened over the weekend when markets were closed. When the futures market opens Sunday evening, the first reaction is going to be oil higher, gold higher, silver higher. The question is whether the dollar also gaps higher on safe haven flows and offsets the move in metals. That is the tug of war I have been tracking. War says gold up, dollar says gold down. The energy strike gives the war side a much bigger weapon than it had before. But I want to be honest about something. We have seen this pattern before during this conflict. Recently, gold gapped up several $100s on escalation news and then crashed when the dollar surged. The market has a way of doing the opposite of what everyone expects on the open and then reversing violently. So while my instinct says gold and silver open higher on the oil news, I am also prepared for the possibility that the dollar surges on safe haven flows and caps the metal's move temporarily. That is the reality of trading in a war environment. Nothing follows the textbook. Everything is headline driven, and the headlines change by the hour. What I am watching specifically is the $85 level on silver. If silver gaps above $85 on Monday morning and holds above it for the session, that is the breakout. That is the signal that the cap is broken. That would change the entire short-term picture and potentially trigger a squeeze on the massive short positions. But if silver gaps above $85 and then gets rejected again, that tells you the cap is still in place. That tells you the big players are using the gap as an opportunity to sell into the panic buying. Watch $85. That is the tell. Beyond Monday, the bigger picture is this. The COMEX silver market is trading on borrowed time. 294 million ounces of paper against 81 million ounces of real metal is not sustainable. The math does not work. The Shanghai exchange with 8 million ounces and active trader suspensions is not sustainable. They are rationing access to silver. That is not a sign of health. And a war that is now targeting oil infrastructure is not going to cool inflation. It is going to accelerate it. Every escalation from here makes the stagflation scenario more likely. I sat with this data all weekend. The COMEX numbers, the Shanghai crackdown notices, the footage of oil depots burning, and the conclusion I keep coming back to is this. The silver market right now is like a pressure cooker with every valve being tightened at the same time. The physical supply is shrinking. The paper claims are growing. The exchanges are restricting trading to slow the drain. And the macro environment is about to get the most inflationary catalyst we have seen since this conflict started. Every one of these forces is building pressure. And pressure cookers do not gradually release. They blow. I am not predicting when. I am not predicting a specific price. I am showing you the data. 3.6 ounces of paper for every 1 ounce of real metal. 8 million ounces left in Shanghai. 40-plus groups of traders suspended in 60 days. 3.2 million ounces disappearing from COMEX in a single day. And oil depots burning on a Saturday night. You can draw your own conclusions, but the data has never been louder than it is right now. Before I go, I want to ask you again, what time are you watching this video? What country are you in? Did you see this before the Monday open or after? And most importantly, what do you think happens next? Drop your prediction in the comments. Tell me if you think $85 breaks this week or if the cap holds. Tell me if you think the oil strike changes everything or if the market shrugs it off. I will pin the best analysis at the top. This is finance currency. If you made it this far, you are part of a small percentage of viewers who actually care about the real data. You are not here for entertainment. You are here for information that could protect and grow your wealth. Hit the subscribe button, hit the notification bell, share this video with anyone who owns silver or gold before Monday morning. They need to see this data before the market opens. The COMEX ratio of 294 to 81 is something every precious metals investor needs to understand. The China crackdown is something no Western media outlet is covering properly. And the oil strike just happened hours ago. Help me get this information to the people who need it. Links in the description. More analysis coming this week as the situation develops. This is finance currency. COMEX registered silver at 81 million ounces. Paper claims at 294 million. Ratio 3.6 to 1 and widening. China suspending traders to protect 8 million ounces. COMEX losing 3.2 million in a single day. Oil depots burning. War entering energy warfare phase. Stagflation timeline accelerating. Central bank decision March 18th. Inflation data March 11th. Silver sitting at 84.47s, just 53 cents below the $85 cap. And Monday morning is hours away. The pressure cooker is full. Every valve is tightening. Watch $85 on silver. Watch the dollar on the open. Watch the oil price. Because what happened this weekend just changed the math on everything. Follow the data, not the noise. I will see you tomorrow.